Okay, everybody, let's get started. Welcome to the February 1st edition of the Fats, Fuels, and Oils webinar. Over the past week, we've seen fats, greases, and vegetable oil prices rise pretty sharply. This is in part due to growing demand from renewable diesel producers, but also fundamentally a bullish backdrop for vegetable oils that seems just to get more bullish by the day, to be honest with you. We raised our price forecast this week pretty significantly for soybean oil and really everything. And honestly, I felt like I could have raised it even more, at least ahead of the US harvest. It's hard to kind of quantify exactly how high prices could go. At this point, we're predicting they're going to top out around the highs from last summer, but the drought in South America is serious, and people are starting to cut their predictions for South American soybean production really sharply. And so you've got soybean prices up 30 or 40 cents today, well above $15, and there's no telling exactly how high they could go. Now, all of that said, the drought is focused in sort of central South America, so southern Brazil, Paraguay, and parts of Argentina. And there has been a shift in the weather pattern that makes the weather in Argentina slightly more favorable. That said, Argentina's soil moisture levels are so low that the crop will require continuous rain or at least very timely rain throughout its growth to make sure that it can reach the levels that people have cut their forecast to already. The same thing goes for southern Brazil and in Paraguay. The crop is definitely suffering. Paraguay is kind of the center of the drought, and so if production is where people expect now or even lower, soybean prices could rise another dollar or two ahead of U.S. planting, and that means that soybean oil prices could, blow through the upper end of our price forecast range pretty easily. Definitely more upside price risk for our forecast than there is downside price risk. Now, we have built into our forecast a decline in prices after the US harvest. We assume that due to one, the price of soybeans relative to corn, and also due to the expense of fertilizer this year, that there's likely to be a lot more soybean acres than maybe people are expecting. I think we're expecting 91 million acres of soybeans in the US this year. And given the cost of fertilizer, which is kind of at levels that we haven't seen since 2005, 2006, it's tough to say that that actually is the number and that it's not necessarily going to be higher. In addition to that, you've had some problems with the US wheat crop that mean that farmers are probably more likely to abandon part of their wheat crop and plant another crop. In a lot of cases, that's soybeans, rather than harvest their winter wheat crop. So all of that could combine to drive soybean acreage much above expectations. And then if we have a normal summer weather and growing conditions, then you could see some pressure on soybean oil prices. That's what we're predicting right now, because of course we don't really know what the weather is going to be like over the next 6 to 8 months. But a meteorologist that I speak with thinks that the US is in sort of this multi-year period where rainfall is going to be restricted in parts of the countries, and he believes that over the next 2 to 3 years we could have a real drought. Now, that is a long-term weather prediction, and I think we all know what long-term weather predictions are worth. They're worth about what long-term price forecasts are worth, to be honest with you. And so we could have perfect growing weather this year, and if we do and have a lot of acreage, I would expect yields to be for soybeans to be well above 50 bushels an acre, and that will pressure prices. Conversely, if we have if we do have a drought this summer, or acreage isn't what I expect it to be, then it's going to be awfully tough to get soybean oil prices to come down. Balancing that, of course, is the expectation that renewable diesel capacity is going to expand pretty significantly over the balance of 2022. Today, I wrote a little bit about the expansion for renewable diesel capacity, and based on where profit levels are, how we kind of expect some of the expansion to slide from the second quarter of 2022 to maybe the third or the fourth quarter of 2022. And so far in 21-22, the demand for soybean oil to be used in renewable fuel production hasn't been as great as we had expected. It's been strong, and it's been stronger than it was last year, but it hasn't been as strong as we might have expected if we're getting all of these plants that are going to open in the second quarter of 2022. If they're going to open a little bit later, and we believe that the plants will open because they're backed by big companies that have lots of financial resources, we think it's just a delay, not a cancellation. I saw an article the other day that said half of the expected expansion probably wasn't going to happen. I don't think that that's the case. I do think it's much more just a delay than a cancellation. So the demand should be stronger in the back half of the year, and that may also offset any pressure on prices from soybean production that is above what the market is kind of pricing in right now, or US soybean production that is above what the market is pricing in right now. In the short term, today we get USDA's fats and oils report, and that will give us data for December production and stocks data for December. We expect stocks to rise in December from November to about 2.5 billion pounds. So in the short term, the soybean oil market is relatively well supplied. The issue is that with what we've seen in terms of the reduction in palm oil production, in part because of the typical seasonal decline, but also because of some flooding that occurred in the end of December and earlier in January, the seasonal decline for Malaysia is a little bit larger than it typically is, and so U.S. soybean oil exports have been a little bit stronger than anybody expected, certainly than I expected. I've been raising my forecast for U.S. soybean oil exports. I've already raised it a couple of times, and we're now at 1.55, and I think I started out at 1 billion pounds. So that is part of the reason why you're seeing the strength in soybean oil, even though we haven't really seen the strength of demand from renewable diesel production that we thought that we would see. We expect that soybean oil stocks will continue to remain pretty high relative to history over the next 3 to 4 months before they start to draw down as the expansion in renewable diesel capacity starts to ramp up. And then, of course, they'll draw down to what we think is going to be about 1.6 billion pounds by the end of the marketing year. That's a little bit below where USDA is, but I think they're going to have to come up on their biofuel use a little bit, and probably come up on their exports a little bit. Offsetting that, they probably also need to come up on their crush a little bit. The NOPA crush report that we got a couple weeks ago showed a record crush, and so the supply is going to offset again a little bit of the growth in the demand from renewable diesel producers, but we still expect stocks to tighten pretty significantly this year. And then what that sets up really for next year is a situation where due to crushing capacity constraints and the expansion in renewable diesel production, a situation where it's very hard to see a scenario where the US doesn't need to import quite a bit of soybean oil. And I think right now we're at a little over 2 billion pounds. That's with some rough, and we use the same process, but with some rough estimates for biofuel demand that may be a little bit high, and we may cut that down. But if we're at 2 billion pounds, maybe we come down to a billion, or we come down to a little bit below a billion. It's still hard to see how we're not going to have a significant increase in US soybean oil imports in 22-23, and a big reduction in US soybean oil exports. All of that assumes that everybody else returns to normal production next year. So no drought in the northern plains or the Canadian prairies. Palm oil production gets back to normal. No problems with the sunflower crop in the Black Sea region. Given the last couple of years, we're probably due for a year where everything goes right. But again, given sort of the long-term weather outlook, it seems like that might be a little bit difficult. And if we have any pressure on next year's demand from the export side, it's difficult to see how prices will moderate back down to even something like 50 or 55 cents. I think that given the current situation, I would say that fair value over the next year or so for soybean oil prices is probably closer to 60 cents than it is to 50 cents. Let's see, for canola oil, we haven't really made any significant changes to our US balance sheets. We'll also get data from USDA on US canola oil production and stocks today, and that'll give us some insight into what US crushing looks like. Canadian crushing has been down year over year, but over the last couple of weeks, it looks like it started to come back a little bit. That little bit is very literal little bit. We still expect crush for January to be below 700,000 tons, which is well below the 900 and I think 16,000 tons that was reported last year in December. And until we harvest the canola crop, I think it's only going to get worse from here. Now, that said, we've got that built into our forecasts. And so for Canada, we haven't really changed our crush forecast, and we still think it's at 885. But we're getting down to levels where if crush falls below our expectations for any given month, we're going to need to start to cut our crush forecast for Canada. Anecdotally, one of the things that we've seen is a replacement in some of the Canadian canola seed imports into the US with canola seeds from Uruguay. Not a significant amount, but it does sort of speak to the overall shortfall in oil seeds and in the strong demand for in part veg oils for in the US, and that is going to be a continuing theme over the next several years, whether the US grows a trendline yield crop or not. We just are going to have so much demand coming online that it's going to be tough for the supply to keep up with it, and even tougher given the capacity constraints for the crushing industry to supply enough vegetable oil to meet all the demand from renewable diesel producers, biodiesel producers, and the food industry and other industries that use vegetable oils as well. For palm oil, cargo surveyor data for January showed palm oil exports from Malaysia were down 25%. I've talked a lot, or at least I've written a lot about the idea that India and Canada will need to restock at some point. And so I expect that 1 month here, and probably in the relatively near future, we're going to get a reversal of this sort of month over month drop in Malaysian palm oil shipments. And Indonesia probably helped out with that a little bit this past week when they announced that exporters are going to have to allocate 20% of their export shipments to the domestic market at capped prices. I've spoken to some people in Southeast Asia, and they expect that this policy probably only remains in effect until palm oil prices start to retreat from recent record highs. Whether they do or not will depend in part on sort of the seasonal pattern of production. So right now, like I said earlier, not only are we in the middle of sort of the seasonal decline in production that typically occurs from September, October to February, March, but we also had some problems with flooding that reduced Malaysian production in January a little bit more than it typically would have. They think that once production starts its seasonal increase, then the Indonesian government will take the requirement to route 20% of export shipments into the domestic market off, and things will return to normal. In the meantime, Malaysian exporters are obviously pretty happy about this development and are going to try and export as much soybean or as much palm oil as they can while this is still in place. And so we might get a bump up in Malaysian exports that isn't necessarily driven by India or China restocking, but just the fact that Indonesian shipments aren't where they might have been otherwise. Indonesian production is a little bit up year over year, so it's not necessarily a supply issue in Indonesia. It's much more just that domestic market has been a little bit tight because there's been pretty strong export demand, and world fundamentals are bullish, and so palm oil prices have risen to record levels even outside of Indonesia. And the government is just trying to respond to do something about inflation for the domestic market and probably to get themselves reelected. So it's something that I think will have a short-term impact on the market, but in the longer term, I think it's just going to be sort of a shift around in trade flows for a little bit, and then we go back to once production starts to swing up, then we go back to whatever normal is these days. Given the outlook for Indonesian production, I think that Malaysian palm oil prices or palm oil futures could go higher over the next several weeks. But again, as we get to the trough in annual production and we start to go up, I think there probably will be some pressure on palm oil prices at that point. Now, that's going to kind of coincide with South American harvest. And even though the crop is expected to be much smaller, there will obviously be a big increase in crushing activity shortly after the harvest and exports based on that. And so you could get a situation that lasts for a month or maybe two, where vegetable oil prices are actually under pressure a little bit earlier than we expect, because of the increase in palm oil supplies and increased supply out of South America. Still, all of that will set up for a summer where before the US harvest, the South American supplies will then draw down as the seasonal peak in crushing passes. And while palm oil supplies will continue to rise throughout the summer, you get back to something where, at least in relative terms, the market isn't as oversupplied as it will be during that period. So I think that, again, I think that I don't remember a period in my lifetime of analyzing these markets where you've just had kind of so many bullish things line up all at once. You have the shortfall in canola, you have the Malaysian palm oil situation in Indonesia trying to limit exports of palm oil. You had the Russian export taxes that effectively shut off Russian exports, and not the biggest crop that we've ever seen in Ukraine for sunflower seeds. And at the same time, you have India and China. While their demand is not what it might have been without the pandemic, they still need to import so much vegetable oil that you're just talking about margin changes at the margin, really, in demand, and the world remains short vegetable oils. So again, I think that in general, the price risk for all our forecasts for soybean oil, canola, palm, and then all the fats and greases, the price risk remains to the upside. All right, on to biodiesel. The EIA also reported that renewable fuel production, excluding ethanol, in November was a new record. One of the things that I kind of wrote about in the soybean oil commentary is if you look at the production from the EMTS and then you tried to allocate out the feedstocks across all of the feedstocks and then across biodiesel and renewable diesel, what you're kind of left with is a shortfall of at least 75 million pounds just based on EMTS production in November. If you just kind of take that total domestic biodiesel and renewable diesel production and you divide the total feedstocks reported by the EIA, the yield comes out at the lower end of the range over the past year. Now, this isn't necessarily unusual, and what typically happens is if the yield is at the lower end of the range one month, the next month the EIA kind of catches up, and the yield will look like it's at the other end of the range the following month. And so I would expect that in December, in next month when EIA releases December data, that will probably get that demand back. In December will probably look a little bit bigger than, or feedstock demand will probably look a little bigger than it actually should be based on just the production. Although we expect another record in December, and so we would expect really strong feedstock usage for December. Our gross margin forecast. Gross margins actually rose last week, just slightly, although for some reason this chart doesn't necessarily show it. I guess it does here. It still doesn't show it. Well, this is without credits, that's why. Gross margins did rise. I looked at the spreadsheet, I can promise that. Marginally for biodiesel, more substantially for renewable diesel. Again, if you think of biodiesel as more of renewable fuel using soybean oil as a feedstock, and our renewable diesel estimates as biofuel production using fats and greases as a feedstock, that can give you a little bit broader context into what margins we're doing. We do expect margins to come under pressure here through the early summer, as we expect that all of the feedstock prices are going to continue to move higher, and we have relatively flat forecast for energy prices going forward. Now, our energy price forecast could also have more upside price risk in it than downside price risk. And so that increase in energy prices may offset any increase in feedstock prices. But given where we are right now, we're just kind of forecasting flat prices. And so the feedstock prices are going to eat into, or we expect the feedstock prices to eat into margins. More so on the biodiesel side than on the renewable diesel side. We expect renewable diesel margins to kind of stabilize around their current level, which is at the lower end of the range over the past year. The other variable in the margin calculation is obviously Rin prices. And this week we raised our Rin forecast pretty substantially. If you remember last week, we were kind of sideways and then up a little bit. And this week we've gone in whole hog and gone up as much as we felt comfortable going up. Although, again, I think there's probably maybe a little bit more upside price risk in this forecast as well. We also tried to narrow the spread between the D4 and the D6, in part because there still is this concern about potential ethanol blend wall, especially if the administration doesn't do anything to change the ethanol mandate. I narrowed it as much as I felt comfortable narrowing it right now, but it also wouldn't surprise me if ultimately if the administration doesn't make any changes, if ultimately that spread is a little bit narrower. And so we could get a situation where you have rising feedstock prices and concerns about an ethanol blend wall driving RIN prices higher. That's kind of what this forecast is based on, but I would say that it's semi-conservative, even though it doesn't really look that way. We haven't narrowed the D4, D6 spread as much as I think it possibly could. And as that narrows, that tends to push prices significantly higher. And there's also potentially more upside price risk for the feedstocks. And so that would also increase prices. An increase in RIN prices could offset the pressure from feedstocks, and so our margin forecast going forward might be a little bit pessimistic, particularly on the biodiesel side. If we really need say 500 million gallons to make up the difference between the D6 mandate and ethanol production, then we're going to need a lot of the biodiesel capacity to remain in business, essentially, and to produce. And in order to do that, biodiesel margins are going to have to support that. And so we've got biodiesel margins relatively negative over the balance of the year. There could be, in that situation, I would argue that biodiesel margins probably be significantly higher than we're expecting. If biodiesel margins are close to our forecast, we think that that really starts the rationalization process in biodiesel capacity. And one of the interesting things in the EIA data was a significant tick down in their reported biodiesel capacity. It dropped by like 74 million gallons a year. It doesn't sound like much in a 2.4 billion gallon from a 2.4 billion gallon capacity, but over the year we haven't really seen biodiesel capacity dropping, or at least the EIA's reported biodiesel capacity dropping. In fact, it increased a little bit up through October basically, and then November it started to move lower. If margins are going to be where we expect them to be, then we would expect that biodiesel capacity would start to come off quite a bit faster than we've seen, certainly last year, and even than we've seen in the past month. That's what our biodiesel production forecast is based on. And I think that there's a good chance that we will have to revise this higher as we go through the year. We set it relatively low based on the idea that margins were going to be bad and capacity needed to rationalize to make room for the renewable diesel capacity. But in the scenario that I laid out, I have to say that I think the decrease in biodiesel production probably looks a lot more like last year, if there's a decrease, than our current forecast. So again, I think there's probably some upside risk to the biodiesel forecast and to our forecast for biodiesel margins. Finally, on the Lcfs credit price, absolutely unchanged from last week. This is the one area that we don't necessarily see a lot of upside price risk, just because we expect that production is going to rise to a level that is going to continue to weigh on Lcfs credit prices. There is some chance that CARB steps in and does something. I don't have a great sense of what that chance is, but given the sharp drawdown that we've seen in prices over the past 6 months or so, or year, I guess, really at this point, they could potentially want to move in and make the credits more valuable. Now, the credits have stabilized around $150 per metric ton of carbon recently. And I think until we start to get this expansion in renewable diesel prices, maybe that is sort of the equilibrium level. And in that case, I guess maybe there is a little bit of upside price risk, but I wouldn't expect that price would last through the end of the year. And I would expect that maybe by the time that we get to the end of the third quarter, that we would start to move down again, just all else equal. All right, with that, I will move on to your questions. Okay, the first one: have forecasts for biodiesel and renewable diesel margin been declining in line with the rise in veg oil costs? They have been under pressure over the last couple of weeks. This last little run up in vegetable oil prices, we haven't really seen is a sharp uptick in Rin prices. And Rin prices went down and they rebounded a little bit, but they've basically been kind of stabilized. And so you are exactly right that for the most part, the decline in margins has been driven by the move down or the move up in feedstock prices. Now, offsetting that increase a little bit has been the increase in energy prices. And so as the energy prices have risen, that's modestly cut into the decrease in margins that we would otherwise see just from the increase in feedstocks. But yeah, the veg oil prices are definitely, or the feedstock prices are definitely the driver in the lower margins. Can ignore the, oh, okay. Sorry. The next part was, told me I could ignore the past question because I was answering it. Sorry about that. Any word on the Jake conference dates location this year? Yes, it's going to be in Chicago. I don't know the hotel name quite yet, but it is going to be, and excuse me while I look off because I wrote it down over here, May 17th, 18th, or 18th, 19th, somewhere in that week, somewhere in the middle of May. I know that they're working really hard right now to try and find a hotel location. And I would expect that we would have that shortly. I would have expected that we would have already known that, to be honest with you. But again, I know that they're working on it really hard, and we should have an announcement out pretty soon about the exact location and the exact dates. But it's going to be in the middle of May, and it's going to be in Chicago, which I love Denver, but I'm in Florida, and so it takes me literally a day to get to Denver and back. So I will be very happy to have it in Chicago this year. With renewable diesel capacity expansion expected in the Q2, Q3 timeframe, taking carbon intensity scores into account, should we expect UCO will be in greater demand from renewable diesel producers as compared to soybean oil or DCO, for example? Yes. This week, when I was incorporating the EIA data into our model, one of the things that I was wrestling with was the allocation of used cooking oil relative to other feedstocks, and whether how to split that not only between the feedstocks, but split UCO use between renewable diesel and biodiesel. And I took a first cut at it, and I think I'm going to be adjusting it here a little bit over the coming week or so. But I favored very heavily UCO use in renewable diesel production as opposed to biodiesel production, and certainly UCO in renewable diesel production over something like soybean oil. Now, the key going forward will be production of UCO or gathering of UCO, I guess, really. If you look at, and I wrote about this week, if you look at the USDA series for food spending at home and food spending away from home, you get a big seasonal increase in December due to the holidays, and then you get a drop off in the first quarter because everybody is bundled up and at home in the northern half of the country, or across most of the country this past week, actually. And so you get a drop off in spending, and then as a result of that, UCO production goes down a little bit. We expect that UCO production is going to be up year over year during the first quarter of 2022, but it's going to be down from where it was in December, or our prediction of where it's going to be in December, and really even in the balance of the fourth quarter. As the Omicron wave passes, obviously more people will start to go out to eat, and that will help. And then as the weather gets warmer, that will also help. There's a seasonal increase into the spring and summer. So you've got an increase in supply that's coming, but you also have this increase in demand based on your question, that will likely more than offset the increase in supply. UCO prices we expect to continue to rise. Both UCO and yellow grease are at record levels already, and we expect that there's probably not going to be a whole lot of relief in either of those markets, although if you look out 3 months, and really even if you look out at the first quarter, year over year, we're going to have more UCO supplies. But it's just a question of when that demand comes on from renewable diesel producers, because you are absolutely correct that they will favor, a lot of them will favor UCO over soybean oil if they're going to ship into the California market to try and take advantage of the Lcfs credits. Any thoughts on Lcfs Q3 generation numbers? Seems a second quarter in a row of large credit generation. Think Lcfs was trading below 140 this morning. Yeah, I think that based on what we saw in the EMTS data, that for, let's see, if we look back to Q3, Q3 was where we had some expansion in renewable diesel production to sort of record levels at that time, but before the big expansion that we saw in Q4. And so that's kind of the thinking behind our forecast, is that starting really in Q4 of last year, and then going forward, we're going to have increasing renewable diesel production, and a lot of that renewable diesel production is focused on the Lcfs credit, on the Lcfs market, or the California market. And so Lcfs credit prices, we think, are going to remain under pressure. For Q3, my guess is that Q3 is above Q2. I don't have the numbers right in front of me to tell you exactly what they are. What I will tell you is that generally the way that we do our Lcfs forecast, at least at this point, is we look at the historical percentage of overall production that finds its way into the California market, and that's how we kind of estimate what we think the quarterly numbers are going to be. I think that we're getting to a point. I was kind of looking at the Lcfs numbers the other day and thinking we're getting to a point where there's going to be so much renewable diesel production that it doesn't necessarily make sense to continue that approach. And so I think what we're going to do is start to change it to do sort of a bottom-up analysis based on Californian demand, rather than domestic renewable diesel production or domestic biodiesel production, because if you do that, it just kind of overwhelms the increase in production, just kind of overwhelms the Lcfs credit market. And while we do think that that is going to happen in some sense, I don't necessarily think that applying the historical percentages will necessarily make sense going forward in the future. Again, that's what we're doing right now. So you could, to get a sense of sort of what we're predicting for Q3, you could kind of go back and look at historically how much of the domestic renewable diesel production or biodiesel production from the EMTS data had gone into California in the third quarter, and that would give you a sense of what our number is. But I think again, probably going forward, we're going to change that up a little bit so that it's not so just they're just become huge numbers that seem kind of ridiculous just on the face of it. But the trend still remains where we think that the growth in renewable diesel capacity is going to, a lot of that is focused on the California market or on the state credit markets more broadly. And so we would expect that you will continue to see sort of year over year increases into the California market until it's saturated and the LCFS credits just don't make sense economically anymore, or CARB does something to change the program to kind of try to limit the amount of renewable diesel that comes into the state relative to the demand. All right, thank you for the questions. I've got to say, you guys always come up with great questions, and I really, that's my favorite part of this whole thing. Thanks for attending, and I will see you again next week when we will talk about the fat and grease markets. Have a great week, everybody.